Hey, what is going on, guys? My name is Nick, and in today's video I have several scary points to discuss about Tesla stock that I think you should all be aware of. Now, this isn't a video I necessarily wanted to make about Tesla, being a huge Tesla shareholder, but I think we should focus on everything as Tesla investors, not just the bullish news. So make sure to stick around until the end of the video where I'll share my overall thoughts and what I plan on doing with my Tesla stock position, whether I'll be buying more, holding, or selling my shares. So if you do enjoy, please drop a like and don't forget to subscribe if you have not already, and with that said, let's get straight into the video. Alright, now the first thing we need to discuss is Elon Musk's controversial internal email sharing that employees can no longer work from home at Tesla. Elon sent two emails on Tuesday where the first email said, "Anyone who wishes to do remote work must be in the office for a minimum, and I mean minimum, of 40 hours per week or depart Tesla. This is less than we ask of factory workers, but if there are particularly exceptional contributors for whom this is impossible, I will review and approve those exceptions directly." Then Elon followed up with a second email with the subject line, "To be super clear," and he said, "Everyone at Tesla is required to spend a minimum of 40 hours in the office per week. Moreover, the office must be where your actual colleagues are located, not some remote pseudo office. If you don't show up, we will assume you have resigned." A little later in the email, he goes on to say, "There are of course companies that don't require this, but when was the last time they shipped a great new product? It's been a while." Overall, there's been a ton of controversy around this because companies like Meta and Shopify completely support remote work, having transitioned most of their employees to work from home roles, while Tesla is going backwards and doing the complete opposite right now. Now, in my opinion, I believe we need to think about Elon's decision in the perspective of running Tesla. Tesla is a highly innovative company enabling all of its workers to have an impact on the company, whether you're a factory worker or a senior manager. In fact, Tesla's anti-handbook specifically states that if employees see opportunities to improve the way Tesla does things, they should speak up even if it's outside their area of responsibility. So then how could a software engineer, for example, help improve different parts of the process if he or she is working from home? Therefore, many people are siding with Elon in that Tesla is simply trimming the fat within their organization and just making it a more lean and efficient organization overall. All the dedicated and hardworking employees at Tesla will want to come into the office, meanwhile the rest will be forced to leave the company. However, I also think that for many other companies, working from home can be a great alternative and it can work very well for certain cases. For instance, I have vestibular neuritis, so driving to and from work for me makes me incredibly nauseous and dizzy. Therefore, someone like me would be much more effective working from home because I wouldn't feel sick all day. Alright, now moving on to point number 2, and that would be Elon's recent announcement on Friday that Tesla is going to be cutting 10% of their salaried workforce. Now, the job cuts won't apply to employees who build cars or batteries or who install solar panels, and the number of hourly employees will still increase year over year. Elon attributed this layoff to many salaried positions becoming overstaffed, as well as having a really bad feeling about the economy, and this ended up sending shockwaves through the stock market on Friday, with Tesla stock being down over 9% on the day, while the Nasdaq was down 2.5% as well. However, I think this is just another example out of so many recently where the stock market is being completely irrational for selling off Tesla stock over 9% just for cutting 10% of their salaried workforce. Like, honestly, does that make any sense? This absolutely makes no sense to me, and it actually should be a net benefit for Tesla at the end of the day. If you think of Tesla's workforce on a bell curve, there's obviously going to be a top 10% and then the lowest 10% of workers in terms of productivity, so Tesla is essentially going to shave off the worst 10% of their workforce. Also, this should help offset some inflationary pressures on Tesla's rising material costs and should help improve operating expenses. Furthermore, Tesla just recently announced that they are going to be planning to have AI Day 2 in this summer, which is purely designed to be a recruiting event. And although Elon recently delayed this event to September 30th, it's not like Tesla is a stagnating growth company now, absolutely not. Tesla literally just grew their revenue over 80% in the past quarter, and they're expected to continue growing vehicle deliveries at 50% plus year over year for a multi-year horizon. So if Tesla can continue meeting their incredibly high demand with less salaried workers, that's going to be a net overall benefit for the company, and therefore Tesla will be a leaner and more profitable organization. So some might argue back and forth whether or not this was a good decision, but at the end of the day, Tesla is going to have a more efficient workforce. Alright, but now let's get into point number 3, which is the title of this video, Tesla's disaster that is inbound. Over the past few months, Tesla's been facing some troubles in China, where COVID lockdowns forced Giga Shanghai to halt production for 22 days from March 28th to April 19th. Then when they tried to restart in May, they faced even more downtime since suppliers weren't up and running yet, and therefore Tesla had to shut down again since they didn't have the necessary parts. Keep in mind, at this point in time, Tesla is still very reliant on Giga Shanghai and is not very well diversified in terms of their production facilities simply because Giga Shanghai is by far the highest output facility that Tesla has. We all know Tesla is ramping production at its two new factories, being Giga Berlin and Giga Austin, but this will take some time to achieve the same output as Giga Shanghai. Anyways, Tesla's Giga Shanghai plant in China is quickly restoring production rate, where it's now at about 70% of pre-lockdown output as of a few days ago. But the Q2 financials will still see a huge impact in terms of deliveries and therefore sales and EPS too. Currently, analyst Q2 deliveries and EPS estimates are still quite high as well. The consensus non-GAAP EPS estimate for Q2 is $2.16, while Q1 non-GAAP EPS was $3.22, so 67% of Q1 EPS. However, I still think Tesla might miss these Q2 estimates based on Troy Teslike's delivery estimates for Q2 being only 249,000, while analysts are estimating 267,000 on average. Troy Teslike has less than a 3% error rate on average over the last 4 quarters for delivery estimates, so I would put much more confidence in these over analyst estimates, which are usually quite off the mark. But we also have to consider the impact of several other items in Q2. For one, Tesla's ramping their 2 new gigafactories, the one in Austin, Texas, and then Berlin, Germany, which is going to add a lot of operating expenses to their income statement in Q2. So I'm thinking that Tesla is going to see margin compression in the short term as they ramp these factories to full capacity. Secondly, Tesla still has their position in Bitcoin that they initiated back in early 2021 for $1.5 billion. But as we can see, the price of Bitcoin is down quite substantially from early 2021, meaning that Tesla will have to record an impairment charge on their net income as an unrealized loss on Bitcoin. And thirdly, Tesla will have restructuring expenses as a part of their layoffs, which will impact their Q2 report. But I would imagine the net benefit of having a leaner and more efficient organization will offset these costs in future quarters, so this will just be a one-time expense. Overall, Tesla's Q2 is going to be a challenging quarterly report due to the Giga Shanghai lockdowns, Bitcoin impairment charges, layoff restructuring charges, and ramping of Giga Berlin and Austin, adding to OPEX. And now the fourth and final point today, we do have to talk about some troubles facing the entire auto industry right now, where the sales numbers came out for May of 2022 and they don't look that great, so let's get straight into it. Here we can see the US light vehicle sales in May of 2022 for several different OEMs, and almost every single brand saw declines year over year except for Genesis, which is a much smaller brand and rose 18%. As for some of the rest here, we can see that Ford dropped 4.4% year over year, American Honda was down 57% year over year in terms of their sales, Hyundai and Kia were down 30%, Mazda was down 63%, Subaru was down 24%, and Toyota was down 27% year over year. As for the total of the 7 reporting OEMs, we can see an average of a 31.4% drop, which is really horrible. This could likely be due to the supply chain constraints and the chip shortage, but I also think there's a net negative impact on the overall demand for gas-powered vehicles. Interestingly, however, Tesla has higher demand than ever before and isn't a part of this group of falling sales like other OEMs are seeing, except for the Shanghai lockdown period, of course. For example, if you want to get Tesla's most popular car right now, the Model Y, you'll be waiting until December 2022 or even March of 2023 just to get one. Similarly, high demand exists for many of their other models, so Tesla is still heavily constrained by supply and not by demand. So Tesla stock really is a safe haven among the mass automakers right now because of their high demand and their order backlog, which they can't even fulfill. So then, based on all of this news, what am I going to be doing with my Tesla stock position over the coming months? Well, probably to no surprise, I plan on holding my Tesla shares and potentially buying more if the stock does dip into the $600 range. I've actually been holding off on buying ever since the stock price started skyrocketing again last week, so I might begin adding again if we do see Tesla in that $600 range once again. I do want to emphasize that Tesla still remains my highest conviction position and the largest position in my portfolio. And everything that I discussed in today's video only represents short-term struggles that Tesla may be facing. Nothing has changed fundamentally about the company, and I remain firmly bullish on Tesla over the long term. But let me know down below what you think about the upcoming Q2 disaster. I would love to hear it. Anyways, thanks for watching today, and make sure to drop a like if you do enjoy this video, and don't forget to subscribe if you have not already for some more Tesla content coming soon. And with that said, I will see you all in the next one.